This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast.
Produced by Bertrand Mériot, a regulatory lawyer qualified as avocat à la cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references.
BERTRANDMARIUX.
Okay, let's get into it. Welcome back. Today, we're doing a very necessary deep dive into one of the most common tools in the Luxembourg corporate finance toolbox.
But also one of the most consistently mismanaged.
Exactly. We are talking about the governance, the documentation, and all the compliance guardrails around PCN account 115.
It really is the workhorse of corporate financing, isn't it? It's deceptively simple.
That's the word. Deceptive.
When a fund or a corporate group needs to get cash into a subsidiary quickly without the time and cost of a formal capital increase, this is what they turn to, account 115.
But that speed and simplicity, it comes with a catch.
A big one. It comes at the cost of absolutely meticulous internal diligence. If that documentation is faulty or even just a little bit ambiguous, you are exposed to some pretty significant governance and reclassification risks.
So our mission today is very straightforward.
Yeah.
We want to give you, the finance professional, the legal counsel, the COSEC manager, you, our listener, a clear, repeatable, and frankly, an audit-grade recipe for this.
Right, for documenting every single cash movement that goes into this account.
We want you to go from maybe being a little curious or even uncertain about this to being authoritative on the topic.
The goal is to build a system that just eliminates that friction with the auditors completely. And I should state this right up front.
Please.
The analysis we're discussing today, it's all based on information that's available as of today, Monday, the 29th of December, 2025.
And that context is so important because these principles are constantly being, stress tested by what people are actually doing in the market.
Exactly. Market practice and regulatory oversight are always evolving.
I think the core issue, the thing we're really tackling, is that the job itself isn't difficult. It's just booking a cash entry, right?
The accounting part is easy.
The hard part is proving the intent behind that cash.
Yeah.
You're basically trading that formal, external legal oversight, from a notary, for your own internal corporate governance.
And if you fail to document that intent properly, that simple funding mechanism turns into an immediate and very expensive headache the moment an auditor or a lender comes knocking.
And that headache, it really centers on the main risk we're trying to mitigate here.
The reclassification risk, that's the big one. It's the danger that an auditor, or maybe a tax authority, successfully challenges your booking. They argue that this account 115 entry, which you intended as equity, is actually debt.
And that doesn't just mess up your balance sheet.
Oh, it goes way beyond that. It can introduce immediate tax liabilities, potentially historical ones. It can even, in the worst case, lead to a narrative of an unlawful distribution. It gets messy, fast.
Okay, so to fight that risk, we've structured today's discussion using the classic 5 W's and an H.
A familiar framework.
We're going to define the what and the why. That's the conceptual core. Then we'll drill down into the how and the where, which is the really precise documentation recipe.
And then we'll get to the when, the rules for when and how cash can actually exit the structure, and of course the who, which is all about the governance anchors.
Let's start with the absolute basics. Let's build the foundation.
That's good.
So we have to begin with the precise identity of this thing. When we talk about PCN account 115 in Luxembourg, what is the official name? The exact label from the Plan Comptable Normalisé is critical, isn't it?
It's absolutely crucial. When you're dealing with Luxembourg accounting and regulatory topics, precision in language is, it's everything. The official label for account 115 is apport en capitaux propres non rémunérés par des titres.
Okay, let's break that down. Apport en capitaux propres non rémunérés par des titres.
And we're citing the PCN framework from Legilux for that exact wording.
So that phrase, it translates roughly to equity contribution not remunerated by securities. Can you unpack the two key elements there? Because they really seem to tell the whole story.
They do. First, you have equity contribution, apport en capitaux propres. This establishes the transaction's fundamental nature. It's meant to be permanent capital.
Risk capital.
It's risk capital, exactly. It's there to absorb losses. It is not meant to be repaid under normal circumstances. Then you have the second part, Not remunerated by securities, not rémunéré par des titres.
And this is the convenience part.
This is the operational convenience point, right? It means the company does not issue any new shares or warrants or anything like that in exchange for the cash injection.
So it's cash in, it boosts your equity, but the actual ownership pie, the percentages, they stay exactly the same.
Precisely.
And that's why you see it so often in private equity and real estate, especially for quick capital calls down into SPVs, the special purpose vehicles. You can skip the administrative lag, the notary fees.
All of that. It gives you incredible velocity for moving cash within a group. But, and this is the big but, because you're bypassing that public scrutiny, that notarized paper trail of a share issuance,
Your internal game has to be perfect.
your internal diligence has to be impeccable. The resolutions, the letters, the accounting memos, you are literally replacing external legal certainty with internal governance certainty.
Which brings us right to the operational stake, the why behind our obsession with documentation. Why does it need to be audit grade?
Because the documentation is the only proof you have of the transaction's true nature. Its primary job is to establish an audit-grade trail of intent and authority.
So you're not just proving the money landed in the bank account.
No, not at all. You are legally proving that this cash is equity, it's not debt, it's not revenue, and critically, it's not some kind of disguised distribution that needs to be reversed later.
I get that the goal is to avoid what you call retroactive storytelling, but what's the practical trigger? When does this actually get scrutinized? It's not usually some big investigation, is it?
Almost never. The trigger is usually incredibly mundane. It's, question 2B on a due diligence checklist from a new lender, or a standard request from your annual auditor saying, hey, can you provide the board docs for the 5 biggest movements into account 115 this year?
And if that documentation is thin?
If it's thin, or if the intent is ambiguous, the company immediately gets stuck in that painful, expensive process of trying to rebuild the intent after the fact.
And I imagine intent that's rebuilt retroactively doesn't look very convincing.
It tends to smell highly suspicious to anyone looking at it.
Let's dig into that reclassification magnet.
What?
When an auditor or a tax inspector succeeds, when they reclassify that equity as debt, what are the specific penalties? This is where the risk really hits the P&L.
The penalties are multifaceted, and they can be quite severe. So if your account 115 is reclassified as, say, a short-term zero-interest loan, a few things happen right away.
Okay, what's first?
First, tax consequences. The reclassification might imply that for tax purposes, the loan should have been interest-bearing, even if it wasn't.
Deemed interest problem.
Exactly. And if a tax authority successfully argues it's a disguised distribution, which is really the worst-case scenario, you could face significant withholding tax liabilities, penalties, and a historical restatement of all your tax returns.
So that's the tax hit. What about the financial reporting?
Your balance sheet has to be restated. Instead of being under permanent capital in the equity section, the amount moves over to liabilities. This can instantly cause you to breach financial covenants with your lenders.
Things like debt-to-equity ratios.
Your debt to equity, your leverage limits, all of that could be triggered, potentially putting you in default. And then there's the third piece.
Governance liability.
Yes. If that contribution was later repaid, as if it were a simple loan, and now that repayment is deemed an unlawful distribution because you didn't pass the proper statutory tests, well, the directors who approved it could face liability, and the shareholder who got the money might have to give it back.
Wow. Okay, that makes what you called headache 1, the trash resolution, an absolute non-starter. Can you give us a really concrete example of why simple language like the shareholder contributes X euros repayable at any time is so lethal?
It's lethal because it shows a fundamental misunderstanding of the legal and accounting difference between equity and debt. Equity is defined by risk absorption. It's defined by the absence of a legally enforceable right to get your money back.
Whereas debt is the opposite.
Debt, by definition, requires repayment. It has a term, or at the very least, an enforceable right of restitution. So when you write the words repayable at any time into your own board minutes,
You're creating a demand right.
you have just created a demand right. You've transformed risk capital into a liability that's callable on demand. You have, by your own resolution, defined it as debt, even if your accountant booked it to the right equity account.
So the paper trail contradicts the accounting entry.
The auditor will just look at your minutes and say, your own documentation defines this as a demand liability, therefore it cannot be equity. It's an open and shut case.
So the message is clear. If you want the flexibility of debt, call it a loan from day one. Formalize it properly. If you want the balance sheet benefits of equity, the documentation has to be squeaky clean and reflect a truly gratuitous contribution.
Precisely. You have to commit upfront. Any attempt to sit in that fuzzy middle ground, that debt-equity hybrid zone. It's not creative structuring, it's just inviting a governance failure. The documentation has to show unequivocally the absence of a legally enforceable right to get that money back, and that requires discipline.
That fear of retroactive storytelling and the huge consequences you just outlined is exactly why we need a bulletproof process. So let's move from the theory to the utility. Let's build the audit-grade documentation recipe.
Right. This is the core deliverable. It comes down to three distinct components, three documents that have to be perfectly aligned. They map the transaction chronologically.
The source of intent, the acceptance of that intent, and then the proof that it was all executed correctly.
That's the flow.
Okay, component one, the funding instruction or contribution letter. You said this is the bedrock, and it needs to come from the contributor, not the company receiving the money. Why is that distinction so important?
Because it establishes the unilateral intent of the capital provider. It confirms, without any ambiguity, why they are sending the money. It stops any later argument that the receiving company somehow, coerced them or misclassified the funds on its own.
And beyond the basics, pair, recipient, amount, currency, bank details, what is the real legal meat that an auditor is looking for in this letter?
The crucial declaration of intent. It must explicitly state that the funding is intended for booking to PCN account 115, and this is where we have to insist on using the official French wording.
The apport en capitaux propres non rémunérés par des titres.
Exactly. Don't let your COSEC teams or administrators use generic English phrases like shareholder contribution or equity injection. Use the official PCN label. It creates the necessary legal anchor.
And to address that whole debt equity blurring problem, how does this letter need to handle repayment? What does gratuitous mean in this specific context?
It must state that the contribution is gratuitous. In this context, that means it's provided without compensation, so no interest, and without a fixed maturity date. Legally, gratuitous confirms the absence of a legally enforceable right to restitution.
So the contributor is essentially gifting capital to the company's equity base.
That's the legal reality of it. If a cash out happens later, it will be a voluntary distribution by the company, not the contributor exercising a right. That distinction is the firewall against reclassification. If the letter even hints at a soft expectation of repayment, it just invites scrutiny.
Okay, that's a solid foundation. Now, component two, the corporate acceptance record. The cash is sent with clear intent, and now the receiving company has to formally accept it with board or manager resolutions. What are the four mandatory actions that have to be in those minutes?
Right, so these minutes are where the recipient mirrors and confirms the contributor's intent. The first action is to simply acknowledge receipt or the undertaking.
So formally note that the money is either there or it's on its way.
Yes, it ties the legal decision to the physical money flow. Second, you have to record the intent and classification. This is where you explicitly restate that precise PCN wording again, linking your decision directly back to the contribution letter.
Mirroring the language.
Mirroring is key. Third, you need a clear accounting instruction. This is the operational bridge. The board or manager must instruct the company's accounting team and its administrator to map this movement to account 115. This proves follow-through.
And the fourth one is the one you said is often overlooked.
It is. The fourth action is to confirm authority. You have to confirm the signatory authority for the banking and payment execution. Who signed the forms, and where does their legal power to do so actually come from?
Let's dig into those authority anchors a bit more. People often just assume a manager has authority, but where does the law specifically anchor that power for a SARL manager versus an SA board?
This detail is so important because the power to accept these contributions has to be legally defensible. For a SARL, a limited liability company, you anchor the decision in the manager's, the gérant's broad authority to undertake acts that are necessary or useful for the corporate purpose.
Which is usually in the Articles of Association.
Right. You have to be sure the articles don't reserve this kind of decision for the shareholders. For an SA, a public limited company, you anchor it in the board's, the conseil d'administration's power to act, except for things reserved for the shareholder meeting. The minutes must reflect their acting within those statutory powers.
The common pitfall here is just drafting generic minutes, right, without citing the source of authority.
Precisely. If that's challenged, the directors might struggle to prove they had the capacity to accept millions in equity without a shareholder vote. A lender's lawyer, for example, will scrutinize that meticulously. Weak authority could mean avoidable transaction.
Okay, that covers intent and authority. Now, Component 3, reconciliation and hygiene checks. This is where the paper trail meets the financial reality.
And this is where we combat what I call evidence drift. It's a huge problem when administrators are managing dozens of entities with rapid-fire cash movements. The link between the corporate record and the ledger just breaks down over time.
So, component 3 starts with
The bank evidence. A clean bank statement showing the incoming transfer, and critically, that transfer must have a unique reference. Then you need the ledger support, which is an internal accounting memo.
How important is that memo?
It's essential. It has to explain how the cash was booked, and it must specifically quote the PCN account 115 label. We don't want to rely on generic software codes. The memo proves that the board's intent was translated into accounting action.
Let's talk more about that evidence drift. You mentioned a funding movements log as a solution. How does that solve the high-volume problem?
Evidence drift is a silent killer of efficiency. It forces firms to spend huge amounts of time and money retroactively matching payments years later during an audit. The solution is just daily procedural discipline.
And the log enforces that discipline.
Yes, the log must link 4 data points for every single transfer: the resolution date, the value date of the transfer, the unique bank statement reference, and the internal accounting entry reference. An auditor sees that log and they instantly recognize governance maturity. If the references don't line up, it's an immediate red flag.
That's a really practical takeaway. And a final hygiene check, foreign currency. What if the investor sends US dollars or pounds? How does the board deal with evaluation?
If the contribution isn't in euros, the board pack has to include a very clear instruction on the FX treatment. Management has to decide and record who determines the spot rate, what the precise source will be like, Bloomberg mid-rate at 10 a.m. on the value date, and what evidence of that rate is kept in the file.
A screenshot, a printout.
Something tangible. If you fail to do this, the auditor will challenge the valuation of your equity entry, and that could force a restatement. It's a simple step that avoids a lot of pain.
So we've nailed how to put the money in cleanly as equity. Now we have to talk about the stress test, taking the cash out. This is where governance can change radically depending on the legal form of the company.
And this is where we run into headache number 3, confusing an equity repayment with a statutory distribution. It's what I call theory D2Y form matters. You have to understand the huge difference between corporate structures like an SA or RL and partnership structures like an SCSP.
Okay, let's start with the traditional companies, the SA and the RSOL. If the cash out is called a dividend or an interim dividend, what statutory mechanics get triggered immediately?
You immediately fall under the very specific and often inflexible statutory distribution mechanics from the Luxembourg 1915 law on commercial companies. It's a massive shift in mindset. You're no longer just adjusting the balance sheet. You're dealing with a public law framework designed to protect creditors.
So let's get specific on the SA, the public limited company. What are the strict guardrails the board has to clear before they can declare any distribution?
The board has to navigate 3 interconnected legal checks. First is the net assets test.
And what does that test entail?
A distribution cannot be made if, right after you pay it, the company's net assets would fall below the sum of its subscribed capital plus any legally non-distributable reserves. It's a core solvency measure.
So the board has to do a calculation before they sign.
They have to look at the latest financials and confirm that total assets minus total liabilities is greater than that mandatory minimum threshold. Second, they have to calculate the distributable amount,
which is the ceiling on what they can pay out.
Exactly. And it's capped by a strict statutory formula. It's the profits of the year plus carried forward profits plus distributable reserves, all minus any losses, and crucially, any legally required reserves. You need a working paper showing that calculation.
And that brings us to the third layer, that specific legal reserve for the SA. Why does it exist, and how does it practically limit distributions?
The legal reserve is a mandatory buffer to protect creditors. The law says that 1/20th or so, 5% of the net profits must be allocated to this reserve every year.
Until when?
Until the reserve hits a cap of 1/10 or 10% of the company's subscribed share capital.
Can you give us a quick numerical example of that?
Sure. Let's say an SA has a share capital of 500,000 euros. The legal reserve target is therefore 50,000 euros. If the company makes a net profit of 100,000 euros, the board must allocate 5,000 of that to the legal reserve before it can even think about what's left to distribute as a dividend.
And if that reserve gets used up to cover losses or something?
Then the allocation mechanism restarts immediately. The next time there are profits, 5% must be allocated again until that 50,000 euro cap is back in place. That calculation has to be clearly documented.
This complexity really highlights why just trying to repay an account 1 in 15 balance is so risky. If a company breaks these rules, what's the ultimate consequence?
The law is very clear on this. Distributions made in breach of these rules may have to be returned by the shareholders.
Like a clawback.
Like a clawback. And this applies specifically if the shareholder knew or should have known that the distribution was unlawful. This risk of forced restitution and the potential liability for the directors who approved it is why you have to be so meticulous when taking cash out of a corporate structure.
Now, let's amplify that risk. Let's look at interim dividends for both the SA and the SARL. These are based on unaudited figures, so the law is even tighter, right?
Right. Interim dividends are a great tool for getting profits out mid-year, but they demand absolute discipline. 3 non-negotiable conditions have to be met.
Okay, what's the first one?
First, the company's articles of association have to explicitly authorize them. If they don't, the decision is basically voidable from the start. Second, you have to prepare robust interim financial accounts. This can't be a back-of-the-envelope calculation. It has to be a proper accounting package showing that profits are genuinely available.
And the third condition is the real killer, the timing constraint.
This is the one that trips everyone up. It's a hard statutory deadline. The decision to pay the interim dividend must happen within 2 months of the date of the interim financial statement it's based on.
2 months? That is incredibly tight in a complex fund structure. What happens if the board meets on day 61?
If the decision is made on day 61, the interim dividend is potentially void. You've missed a statutory timing requirement. If challenged, the whole distribution is at risk.
So if your interim accounts are dated September 30th,
the decision has to be finalized, minuted, and signed by November 30th. It forces you to schedule board meetings backwards from your accounting date, not forwards.
This perfectly shows why confusing a repayment of account 115 with a dividend is so dangerous. If an auditor reclassifies that cash out as a de facto interim dividend,
you are suddenly subject to a 2-month timing rule you almost certainly didn't follow. Auditors often use a substance over form argument here. If it looked and smelled like a dividend and you missed the deadline, you're in a defenseless position. That's the price of weak governance.
Okay, let's switch gears and look at the comparative simplicity of the SCSP, the Special Limited Partnership. Why is the cash-out process so different here?
It's like being on a different legal planet. The SCSP is governed by contract law, not corporate law. So its governance is anchored almost entirely in the partnership agreement, the LPA.
So we can forget about the net assets test and the 2-month rule.
Completely. For an SCSP, the question is always just, what does the LPA say? Distributions and refunds are a contract story. The LPA defines the waterfall, the conditions for payment, and any clawback mechanics. You have to get out of that corporate dividend mindset entirely.
What are the practical implications of that difference?
The main thing is flexibility. The partners can agree to incredibly complex distribution mechanisms, but the rigor just shifts from checking the 1915 law to meticulously checking the LPA. If the LPA requires an advisory committee vote, you better have a record of that vote. A failure to comply is still a governance failure, but the remedy is contractual, not statutory.
Okay, we've built the framework for cash in and cash out. Now let's synthesize all of this into a solid COSEC and governance checklist, the operational guide that people can use right away.
This needs to be a repeatable workflow, and it has to start before a single document is even drafted. We call this the pre-deal classification gate.
What needs to be confirmed at that gate?
You have to confirm the intended instrument. Is this a formal share capital increase with a notary? Is it a shareholder loan, which needs an interest agreement? Or is it an account 115 contribution? If you get that wrong, your whole documentation package is wrong from the start.
And you also need to check existing agreements.
Yes. Review finance documents, covenants. Do they restrict equity injections? Do they have leakage provisions that restrict distributions? You can have perfect documentation, but if it breaches a covenant, it's useless.
Moving to statutory hygiene and records. Since account 115 doesn't involve issuing new paper, what's the mandatory non-action that can trip people up?
The mandatory non-action is this. COSEC teams must not record a change in the share register. If you do, you are implying a share issuance, which flatly contradicts the definition of account 115. The equity balance changes, but the share count stays the same.
And the solution to evidence drift, that funding movements log, that needs to become a mandatory policy.
It's a simple spreadsheet, but the discipline is paramount. Resolution date, value date, bank reference, accounting reference. That log becomes the single source of truth that links the legal decision to the financial result and removes all that audit friction.
Now, the decision gate for later cash outs. Every cash out needs a clear legal identity before you even minute it.
This is the moment of truth. If you structure it as an SA or RRL dividend, your board pack has to include the calculations for the net assets test and the distributable amount.
And for an interim dividend, the demands are even higher.
Much higher. The board pack has to show the articles authorize it. It must include the interim accounts package and, if required, the auditor or revisor report. And the date on that resolution has to mathematically comply with that strict 2-month rule.
And if the decision gate points to an SCSP refund,
then the focus is entirely on contractual compliance. The board pack needs an extract of the LPA, it needs to show the required approvals have been gathered, and it needs to confirm any restitution clauses have been acknowledged. You're checking the contract, not the company law.
based on all these potential failures, what's a quick red flag list that professionals should be watching out for?
Okay, here's a quick utility summary. Red flags that signal imminent audit friction. 1. Late minutes. Resolution signed after the cash has already moved. 2. Generic wording, using English templates instead of the official PCN wording. 3. Any repayment language, using words like repayable or returnable. 4. Reference mismatch, where the bank reference doesn't match the resolution. And 5. The interim dividend missed deadline, signing that resolution even 1 day late.
Finally, the ultimate output, the final evidence file, the package that should be ready to go when the auditor asks.
The ideal file is a single indexed PDF for each transaction. It should contain 5 things. 1. The signed resolutions. 2. The initial contribution letter.
Okay.
3. The bank reconciliation showing the statement extract matched to the reference. 4. The internal accounting memo that quotes the PCN 115 label. And 5. If it was a cash out, all the specific dividend documentation like the interim accounts and any required reports.
Having that file ready transforms a complex audit query into a simple email attachment.
Exactly.
We've established the standard. Let's pivot to immediate practical application. For companies with a 31 December year-end, what's the critical calendar alignment for Q1 and H1 2026?
Okay, immediate calendar diligence is needed. For an SA, the annual general meeting to approve the 2025 accounts has to happen inside the statutory 6-month window. That means the meeting must be held no later than June 30th, 2026.
A hard deadline.
A hard deadline. All your board approval meetings for the annual accounts have to be scheduled backwards from that date.
And if they're planning an interim dividend in the first half of 2026?
That requires, well, military precision. If you plan an interim dividend based on Q1 results, so accounts dated March 31st, 2026, the decision must be finalized by May 31st, 2026.
That tight 2-month timing constraint again.
It means you have to lock in your board meeting dates before Q1 even ends. If you let things slide, that window just slams shut.
A quick note on cost. Account 115 is popular because it's cheaper than a formal capital increase. How big is that difference, really?
Operationally, it's significant. A formal capital increase has notary fees, publication costs, longer lead times. Account 115, done correctly internally, bypasses all of that, but you have to internalize the cost of internal failure. Saving 5,000 euros on a notary means nothing if the audit failure costs you 50,000 in remediation.
And we must reiterate the tax caveat.
Absolutely. We're talking about legal and governance hygiene here. Tax treatment is a completely separate and specialized work stream. It has to be handled by qualified tax advisors.
But clean governance helps the tax case.
It's a foundation for it. If your documentation is ambiguous, your tax advisors will struggle to defend the equity characterization. Good governance supports good tax treatment.
And finally, from your experience, what's the number one point of friction when external parties, especially lenders, review these account 115 balances?
It is always, without fail, ambiguity around any perceived repayment right. Lenders hate what they call soft equity because it can be pulled out without the strict solvency tests that protect them.
So if there's even a hint of a repayment right,
the lender will treat it as junior debt and impose much stricter covenants on it, or demand that it be formally subordinated and made irrevocably non-repayable. It has to be written crisply right at the start. No repayment right, period.
So we've covered the definition, the rigorous 3-part documentation recipe, and the complex rules for cash-out. The central takeaway seems to be that administrative soundness isn't just a formality, it's Luxembourg's competitive bedrock.
And that leads to the final thought I want to leave with you. Luxembourg provides stability because its rules, while they're complex, are predictable. The system is designed to be boring in exactly the right way. It delivers certainty.
Until it's not boring.
That stability holds true until your evidence file isn't boring. When you have ambiguity, when you've relied on folklore instead of the precise PCN label and statutory rules, that's when the audit or the regulator gets excited. And it gets exciting for all the wrong people. The long-term cost of retroactive storytelling is so much higher than the small effort of disciplined, upfront diligence. Discipline really is the only guarantee.
Please rate us on Apple Podcasts, follow on Spotify, or subscribe to Rigore Media and Bertrand, M-A-R-I-U-X, on YouTube. Connect with Bertrand on LinkedIn. Visit BertrandMurillo.com. All links are in the show notes. It was the Luxembourg Fundcast for you today.